Welcome everyone. Thanks for coming to our presentation on what will most likely be the most boring content for the session. Boring for us, maybe, and for you guys, but we love it. It's a good chance to talk about tax to people that hopefully appreciate it. So today we're going to be talking about the digital games tax offset, and we've tagged this as application in practice, which is a little optimistic at the time because, of course, no one's really actually applied this in practice. But we can speculate, and today we'll do that for you. Obviously, as most of the room will be aware, the legislation has been proposed, but we haven't seen the final finished product. So please be aware of the fact that everything we cover off today will likely need a little bit further tweaking along the way. I have it on good authority that it's not going to be dramatically different, but there will be some changes. It's probably worth making comment, thanks to, there's even a couple of people in this room who've contributed to this legislation, and IGEA have been a real champion of driving change in this space. So it's quite a really attractive offset that's been introduced, and something that we're hoping will really drive the industry here in Australia. So we're really looking forward to be a part of it. Just a general disclaimer. Be aware of the fact that it's all draft legislation. Nothing is necessarily defined specific to your circumstances, so seek advice. I'll hand it over to Amy, my colleague, who's going to be talking with me.
Thank you, Luke. So obviously today we're going to go through the draft legislation, as Luke said. We're also going to explore some of the material that was mentioned in the explanatory memorandum, so that's known as the EM, that goes with the draft legislation. So we'll try and unpack as much of that as we can in this short period of time. We could probably go on for a whole day session, to be honest with you, but we will leave some time for questions at the end, and we'll obviously hang around as well. So what is the digital games tax offset? So it's a refundable tax offset of 30% of a company's qualifying Australian development expenditure. And that expenditure needs to be on completing a new digital game, porting a completed game to a new platform, or the ongoing development of a completed digital game. So it's important to note that there is a minimum spend requirement under all three of those criteria, and that is $500,000 $500,000. So under the draft legislation, it's proposed that the offset will be available from the 1st of July 2022, which is actually the current financial year that we're in. So we'll be interested to see, and why we're all sort of waiting and speculating that it will be hopefully released shortly, because we are getting well and truly into the current financial year. So tax offsets, I mean, what is even a tax offset? So there's a lot of talk about it, and we should probably explain what a tax offset is. So a tax offset is an amount that directly reduces the amount of tax payable that a company or individual pays on their taxable income. So regular tax offset, thank you. Sorry, one moment. Thank you so much. So regular tax offsets reduce the amount of tax payable to zero. However, a refundable tax offset can actually create a cash refund in the hands of the taxpayer. So what that means is a company might have a taxable income of $100,000. The tax payable at the corporate flat rate might be $25,000, which is 25%. And if they were entitled to a refundable tax offset under the DGTO of $30,000, that net amount of $5,000 would actually be refunded in cash, which can be very lucrative depending on the company's taxable position. So what is the amount of the tax offset? As we mentioned, it's 30% of the company and the related company's qualifying Australian development expenditure. We will cover the definition of qualifying Australian development expenditure a little bit later in the presentation. It's important to note, though, it is actually capped at a $20 million cap. So with that, it does sound like it's a relatively low cap. However, it's important to note that that's the actual amount of the offset. So the amount of qualifying Australian development expenditure would need to be over $66 million to reach that $20 million cap of the offset. So $20 million being 30% of the $66 million spend. So it is quite large, but it is worth noting that that is one of the points that IGEA did raise in their paper, that it does kind of limit the value of the offset entirely.
Certainly for some of the larger developer groups out there.
Yeah, absolutely. And particularly if there's external investment, which is what the offset is designed to bring into Australia to create jobs within the industry. So with that cap though, I mentioned related companies. So the easiest and most straightforward application of this is to a company that's carrying on the development themselves. That's quite easy, that's quite straightforward. It's just whatever the company spends and what qualifies under that eligibility. With related companies, you might have a series of companies that are under common ownership or common directors. When that happens, the cap is still $20 million between all those entities. The definition of that is a funny one. It's listed in many tax legislations. It's a bit grey, but essentially it's if there's similar ownership, similar directors, they're expected to act in accordance with each other or in concert with each other. And in theory, that by making one decision in one company, the other company would also benefit from it. That's generally when a company is considered to be related or affiliated. So that $20 million cap does apply to those related companies. Each company can apply for the offset themselves. However, it's a max of 20 million between a connected group of entities, which unfortunately, as IGEA mentioned in their paper as well, there is also an issue with that, and that is that if you go over that $20 million cap collectively as your group of companies, there is actually a penalty that you will be denied the full amount of the offset, not just the amount in excess of the 20 million.
Or a risk of.
Yeah, which is particularly harsh, and I think that's probably something that will change in the final legislation when it comes out. But it is worth noting that even if it's an administrative error, Company A said to Company B, we're claiming this amount, you claim that amount, and it was over the cap, you will be denied the full amount under the current draft. So hopefully they change that going forward. So which businesses are eligible? So a company is eligible for the offset if it has been issued what is known as a completion certificate from the Arts Minister. The company also needs to claim it in their tax return, and it needs to be an Australian resident company with an ABM. There is a little loophole there for foreign resident companies who have a permanent establishment here within Australia. That's a very specific definition and essentially means that there's an operating business here on Australian shore, employing people here in Australia. It's probably not as relevant to probably you guys here today.
Don't commonly see it. Most businesses that operate in Australia, even if they're foreign owned, will operate via an Australian registered company structure. So it's important for everyone in the room that Australian registered company is probably the way to go. We commonly see that for most studios anyway.
Yeah, absolutely. And so a company is eligible if they are primarily responsible for the actual development of the game. So the easiest example is a company that owns or controls the rights to the game and they undertake the development themselves. There is a little bit of a leeway there for companies who are engaging other companies, and they can sometimes access the offset, but it's a little bit more niche, and the most straightforward example is you developing your own game and owning your own IP, essentially.
Excuse me. Can we ask questions as we go along? I know you see questions later, but it might be difficult to swing back on some of these.
Yeah, absolutely. We're happy to do that.
Yeah, quick ones. Yeah.
Yep.
Sorry, just Arts Minister, how do we get this certificate from the Arts Minister?
That will come up a little bit later, but that process is also under review with the final legislation. So it's not clear exactly what it will be, but it will be an application.
The EM does mention the fact that they'll produce information on that application process in due course. Yeah, so that one's definitely in the dark at the moment.
Yep.
Yeah.
Yep. Okay. We'll continue on.
Okay, so what games are eligible? It's really designed for games that are released to the public for entertainment or educational purposes, and the game must be available over the internet, played through the internet, or operates when a player is connected to the internet. So there's quite a sort of particular niche there, but I suspect these days that connectivity is pretty standard across the board. The key here is that it must be made available to the public. So there's a release date in question. Now that becomes important when we start talking about the certification process and the different types of certificates that are there. There's a little bit of ambiguity there as to exactly what that release date is. But in general, it's when it's made available to the public. So I'm keen to sort of watch this space and see what the final legislation actually says in regard to that.
So the first one made available for use over the internet. That means you can get it on Steam, right? Or does it mean it's an online game?
I think in principle, if it's made available on Steam, you qualify. Yeah. Yeah.
It's unlikely, but if on the chance that the developer releases only physical copies of their game, they probably wouldn't be eligible for this, would they?
Depends on the nature of the game, I would suspect, so you'd need to have a look at that piece. Yeah. If it's physical copy only, I don't know that anyone's... Maybe there is someone out there that's still releasing physical copies only.
Does public also include beta versions?
So there is an allowance for testing, and we'll come to that in a tick. So let's talk a little bit about the specific exclusions. The big one is obviously gambling games or games with gambling element, and there's a specific reference there to loot boxes. Now that's obviously an interesting point because we're seeing a lot more use of loot boxes within titles, and there's certainly some more guidance that's expected to actually understand exactly how it's going to come to play. We're seeing, interestingly in Amy and I's client base, more and more, I suppose, crossover between loot boxes, interestingly with the crypto in particular aspect. So that interplay at the moment seems like it's going to be probably ruled out, but certainly watch this space and it may shape the way in which loot boxes are integrated in games. Other elements that are excluded are games that obviously refuse classification, which introduces a degree of ambiguity again. Classification's obviously an interesting one to many people. We have seen in the past some games refuse classification. I think by and large the majority of Australian content hasn't had that issue, but it has come up in the past. There's obviously also the more corporate use, so anything that's primarily developed for industrial, corporate or institutional purposes, or otherwise there to advertise or promote a product, entity or service. An interesting one again, we're seeing a lot more insertion of content within games where there's a degree of advertising necessitates the game or maybe originally drives the game, but I think that the key here is that primarily developed to advertise. So let's have a chat about the three different types of certificates that are there. The completion certificate is the first, and that is issued when a game is completed during an income year. The company has to make an application to the Arts Minister, as we touched on earlier, and we're waiting to see what that looks like. And qualifying Australian development expenditure has to reach that $500,000. Amy will cover off a little bit about development expenditure and what's in and what's out. That $500,000 is a hard cap, so we need to make sure that is reached. There is obviously support there for development projects that are below that $500,000, and Screen Australia's got some really great grants out there. So if you don't believe you're going to reach that $500,000 threshold, certainly explore what your other options are. It's important to note that this is done, this completion certificate is for the completion of the game, so that $500,000 can cross over multiple years. It's about completion of the title. The second certificate is the porting certificate. So again, this is issued when a game is ported during an income year. I'm sorry, I have glossed over that key point. Income year, for the purposes of everyone in the room, is the tax year, which is the 1st of July to the 30th of June. So we're talking very much about tax periods here. Again, the company must make an application to the Arts Minister, and qualifying expenditure must be that $500,000. Could be incurred across multiple years again.
Worth noting that for porting, $500,000 is actually quite an excessive threshold, so we are hoping that they will revise that, potentially bring it down. Quite often doesn't cost $500,000 to port a game, unless it's a particularly large.
Yeah, I think it depends on the title and what's there. So it's probably going to be more relevant for the larger studios.
Excuse me, so you can qualify over multiple years, but do you claim over multiple years as well?
Correct.
Yeah.
You do, yes. Yep, but the claim occurs
Within that financial year.
in that year of release.
Yeah.
Yeah,
Yeah.
which will go back. Did I haven't see another hand there?
No, I'll just wait till the certificate, which might answer it.
Sure.
I was just going to ask, what was the date for the financial for the tax year again?
1st of July to 30th of June. Unless you've obviously got a substitute accounting period lodged, which may be applicable for some of the larger corporates.
Maybe just touch on how work and hire agreements can be interacted with it.
We'll come to that. Yeah, we'll come to that. The third certificate is the ongoing development certificate. So this is the one that's a little bit more interesting. This is in regard to existing titles, so those titles that have perhaps already been certified under the earlier versions and will be subject to ongoing development. Again, it's the $500,000 threshold, but this one's actually for the year, but can be across multiple titles. So it's important to understand that difference there. The first two certificates are focused on titles and across multiple years. This third one is a little bit more of a catch-all, but will focus on multiple titles, but in that one income year. Again, there's an application process with the Arts Minister. We don't know what that looks like yet. Yeah. So I'll hand over to Amy to talk about what's in.
Yeah, so the draft legislation lists out a number of eligible expenditure, and it actually specifically lists these in the legislation. So I guess that's the easiest way to make sure it's in, is having it listed. It doesn't mean it's a comprehensive list, and some things might meet that definition or might not, but it does provide you with that guidance. So the main one that you're going to come across predominantly is going to be the remuneration of your employees or contractors. So this can include the wages and superannuation of the employees or contractors, if applicable. So it actually lists out a number of titles or roles within your studio, and that includes software developers, programmers, game designers, writers, animators, artists, musicians, project managers, QA testers. It's actually quite an extensive list. However, there are some notable absences there. Things like community managers and producers actually aren't specifically listed on there.
Might be worth touching on engineers is sort of an interesting term as well, that it sort of focuses very much on the software aspect of it, but there's sort of ambiguity there as to whether that extends to, say, an audio engineer, for example. I think we're expecting that will play out a little bit more in detail once we see the final legislation. Got a hand at the back.
Yep, question up the back. We'll really have to wait for the final legislation. It might be that list is expanded, or there might be a bit more of a catch-all that might allow you, I guess, to claim a producer or something there. So we really need to wait for that one, because it's a pretty key role in a development. So I think there will be some revision there, or we hope there will be at least.
Yeah. Or clarification at least.
Yeah.
I guess on the similar vein, it's like admin staff and things like that.
They're actually, so in the next slide, the admin staff are actually specifically excluded, and essentially because they're to help you run the studio and the overheads. So they are considered an overhead, which is actually excluded under the draft legislation. So I don't see them as being adjusted, but producers and community managers and that sort of thing, there's possibly some element there that might come through.
Take producers out of the mix and things get pretty messy.
Yeah, exactly. And I think they know that.
Slightly dumb question, but you mentioned that admin staff is considered overhead. What exactly does overhead mean in this context?
So an overhead is essentially something that makes your studio run. So it's a necessary cost that may not be directly related to the development of the title or the game. So it might include something like an administrative staff, your corporate structure, so your legal fees or accounting fees, or potentially even your office costs can sometimes form part of your overhead. Yeah. Just depends on your business structure and what's directly attributable to the game generally. So to just continue on with some of the other eligible expenditure that's specifically listed, and that includes research expenses, prototyping, user testing and debugging, expenditure on obviously updating the game, obtaining or maintaining some sort of classification, or adapting the game to a new platform. So that last one is clearly in relation to the porting certificate. It's worth noting that all of these expenses are really heavily focused on salary or contractor amounts that you will pay. So there's a heavy focus on jobs and encouraging jobs here within Australia. Yeah. Now, the list of excluded expenditure is actually quite long. So you'll notice there's only 2 slides of included, and there's about 4 slides here of excluded. Again, it's worth noting, look, some of these things are listed on here. They may or may not change, we don't know. But for the most part, it's generally expenses that are related to the overall running of the studio and not so much the development of the game and the actual tech and the expertise, because that's what they're trying to encourage here in Australia, is bringing jobs and expertise here and allowing our people to be able to, contribute to that. So some of the excluded expenditure is expenditure that is subcontracted. Now, this is an important one because there is actually a bit of clarification that needs to happen on this. So it's fine for the company that's claiming the tax offset to subcontract and claim the amount of that under the DGTO. So that would meet the contractor definition under eligible. What they're referring to here is if that company then subcontracts to somebody else and that expenditure is actually ineligible. So it's sort of the company claiming the offset, they can subcontract and they can have people help them and that's eligible. But if they then contract another company, it's designed to capture that expenditure. That is in the legislation and it does explain it a little bit more in the explanatory memorandum.
It's worth sort of focusing in on that because there's some challenge there in terms of identifying exactly when subcontracting occurs. So I think it's important to note when you're entering into contracting arrangements with parties that it may be that you need to ensure there's specific clauses in there that prohibit subcontracting as a way to protect and ensure you've got eligible access here.
So could that apply to a subcontracted company hiring an ABN, as in a person who's not working on fair wage?
Yeah, correct. Yeah, so you go down the chain. That's right. Yeah, so it's pretty. I think it's administratively difficult in that space, but I suspect there'll be more guidance on this. Yeah.
So incidental expenditure and general overheads were another one that are excluded. So again, that's things like the premises, your electricity, your running costs, the overhead expenditure of running a business, whether it's administrative staff or accounting fees to set up your organisation. Yep.
For example, incidental expenditure to, in case of like file recovery or something like that, or hardware failures to replace something like that.
Yeah, look, essentially, yeah, and actually further down the list, so hardware is actually specifically excluded, which I'll get to that, and that's another point that's important to make.
Would you be happy to share a presentation afterwards?
Yeah, absolutely. Yeah. So you don't need to take photos of the slides.
We're
That's
conscious
fine.
there's quite a bank of slides there, so we're
Yeah.
ripping through as quick as we can.
Yeah, I'm trying to keep it to the 40 minutes. So expenditure in connection with engaging employees or contractors who are not related to game development roles. So that's what we mentioned before, which is the administrative staff. And also anyone who's not an Australian resident at the time that they carry out the expenditure. So if you are contracting someone overseas, which can be quite common for a particular role, that's unfortunately excluded expenditure as well. Again, it's trying to bring development to Australia. The question up the back there?
When you say Australian resident, do you mean tax resident or?
I believe it's tax resident, yep.
Yeah, it's located here.
So following on with the second slide of excluded expenditure, obviously anything to do with travel, accommodation or entertaining, so that expenditure is not related to game development, so that's clearly out. Marketing, advertising, publicity and promotions, so anything advertising your game, again, it's not the actual development, that's more the commercialisation of the title. Interestingly enough, the one that's probably really important to note is computer hardware, software and servers. So it's interesting that they've actually included them on the expenditure that's excluded list because it is vital software and hardware that you need to create the game. I wouldn't be surprised if possibly something changes there. It is a little bit different to the film offset in that particular space, so it might have room for movement, but at the moment, unfortunately, any software, hardware or servers are out.
I think it's worth sort of emphasising here, Amy, that the key seems to be a focus around jobs and that employment piece, hence why you're seeing exclusions there on hardware and software.
Yeah. It also goes on to exclude the use of land or premises, so that's essentially your rent, your office space, that sort of thing, if you own the building. Copyright, trademark and licence costs, again, that's more about protecting your IP and about commercialisation type arrangements, and financing expenses are to be borne by the studio themselves. There's one last slide of excluded expenditure. And this sort of goes through most of the things that we sort of touched on, but any sort of insurance, audit, accounting, HR and legal costs, they're all considered sort of general overhead costs and not actually related to development. And one important one to note is expenditure that's been claimed under the R&D tax offset. So these tax offsets are very separate from each other, but it's important to note it's either one or the other. You're not going to get the double claim then.
We probably sort of see there an interesting interplay. Traditionally, over the last certainly 20 years, R&D offset's been a big component of a lot of studios. We've seen it in probably the last 5 years drop back a bit, particularly as people are more relying on external tools and other software solutions to drive R&D or to drive development. So in this instance, we're probably going to see, I think, a clearer definition between those studios who are developing tech internally versus those that are developing individual titles, and the need to really delineate those two. Technically, that's probably already been there in a sense because the R&D offset requirements have required clear identification of R&D work, but this should likely expand on that a little bit more.
A question down the front there.
What is R&D tax? What's the R&D tax?
So the R&D tax offset is the research and development tax offset. So that obviously has its own set of rules there, and it's more focused around developing, as Luke said, actual IP within the company. Correct, yeah. So it's sort of, they do work together there. Another important one, though, is non-arm's length transactions. So a non-arm's length transaction is essentially a transaction that's not on commercial terms. So it might be, probably the most common one you might see is a director that's taking a salary or wage from the company. Quite often in the early days, you might be taking a wage of 50K, and that's nowhere near what a commercial person doing your role would be affording in the open market. So interestingly enough, those non-arm's length transactions are excluded expenditure, which can be problematic because in those early days, like I said, you may not be actually paying yourself the full amount. That's problematic for two reasons. One, because it's going to be difficult to get to that 500K minimum threshold if you're not paying yourself the full salary. And two, if you're not paying your full salary, your entire salary will be excluded under this non-arm's length transaction clause. So it's an interesting one. That's
particularly for smaller studios.
Yeah, for the smaller studios.
For the larger studios, maybe it's less of an issue.
Yeah. I think we have a question in the middle.
Just to be clear, if I'm a director and paying myself a salary, that's just not included at all?
No, so if you're paying yourself a market salary, so if you're a programmer and your market rate's 100K and you're paying yourself 100K, that's fine. If you're paying yourself lower than that, that's not considered an arm's length basis because it's not a commercial basis. So unfortunately, it's excluded. Yeah.
So it's something to be aware of, that particularly for a smaller startup studio where there may not necessarily be money for the key owners or studio owners, that there's usually a compromise there, and that compromise in this instance may be a little bit awkward. It's worth emphasising. I suspect they'll change a little bit of this just to make it a bit clearer. Yeah, question there.
It's a very good question.
Yeah.
We actually don't have the answer for that. They would look at the industry benchmarking.
Suspicion.
Yeah, they have a lot of information from companies' tax returns and payroll information under the single touch payroll regime. So they'd be able to benchmark it, but whether we have access to what those rates are is another question.
I mean, I think it's still operating under the tax regime, so there's a self-assessment component there. I think in principle, if you are comfortable that you've got, within a market rate, you should be okay. We may be a little bit cautious here. What you're seeing is a bit of conservatism from accountants, unsurprisingly. Yeah. It's worth noting that, but hopefully, in practice, we'll see a little bit more flexibility there around that piece. The question back there.
Does that also apply to contractors? So if you're contracting somebody out, that would be under sort of like market value or something like that? Is that going to come into that category as well?
I think what you'll probably see is if it's a third-party contractor, you'll usually see some sort of commerciality to the arrangement. As to how it's going to interact with things like earn-out agreements and the like, there's probably not going to be a great amount of interaction there. So that's something to be mindful of. I think in an ideal world, what you'll see is a promotion of people being paid the correct amount. Yeah. Which may be a problem for smaller studios. A question at the back here, and then we're going to move on. Yeah, I mean that's a really common issue that we're seeing in the industry, and there's lots of problems with that, particularly regarding minimum work conditions and the like. So I think that's an important conversation to have, and it will certainly influence what's going on here. Because you keep in mind, if you're not paying them that salary, you're going to struggle to get up to that $500,000 minimum spend.
Just to continue on a little bit here. So the distribution and user acquisition expenses are also specifically listed as excluded. Again, more in relation to commercialising and marketing the game, and visa costs. So that's again, visa costs are bringing foreign residents here to work. So usually they're excluded from the expenditure.
So we might just talk a little bit about what a qualifying Australian development expense actually is. So it's incurred or reasonably attributed to goods or services provided or acquired in Australia. So there's that, bringing it back to Australian focus. So we're not talking about anyone that's employed overseas. And there's a grey area there, an allowance, because of the excluded activities and, you know, the fact that, for example, time in relation to the certification process is not considered development time. There's an allowance of what we call 10% leeway there for internal use. So you can, despite the fact that a developer may be employed by the organisation, be performing some work that is not necessarily directly related to development, as long as that is less than 10% of their time, 100% is going to be captured, 100% of their salary cost. Other than that, if it's not substantially attributed to development, then it's a proportionate basis. And there'll be a need there, I think, to do perhaps for those staff that are working across multiple projects in particular, I need to do sort of time sheeting or some form of record keeping to understand when they're working on particular projects, because each certificate is unique in that instance. You've got a question down the back there? Sure. Okay. The timing is really important here. So it's once the game is ported, and so this is in regard to the second certificate, you actually apply for the porting certificate, and the day on which the completed game is either available to the public or released is actually the hard cut-off, and then after that point it's going to come down to whether it falls under the certificate 3. So it's important to be really aware of those dates and make sure you're focused on the timing. So again, I think record keeping will come to the fore here. What we're seeing probably for clients, particularly regarding R&D, is the use of GCAP, code logging and the like, to sort of focus in on when, where a project's at and when time's been allocated. But it may be even down to maybe using timesheets is possibly a way to do it, or even looking at sort of, if you're using some sort of agile development, you've got an idea of where people are allocated on projects, relying on that and keeping really good records.
Question down the front there?
Yeah. Not so much titles, because the title would be released or ported. Correct. Yeah. Yeah. Correct.
Yeah. The cap is still 20 million though, so cap applies per company. Yep.
Including, but you've got that related company
Related and
issue.
affiliates. Yep.
Yeah. Confused yet?
I think we have another question, Blake, up the back there.
Yeah, real quick one. Assuming you have a game development right now,
Yeah.
and you release it on the 2nd of July, 2023, so this just falls outside the current tax year, are you only able to claim all the development work in that 2022 year?
When you say claim, so you're talking there's a release.
Qualifying expenditure under the 2022 year fall under, even though your release date just fell over the other side of the next tax year.
Correct. So then if it fell over to the other side, then you would claim in the year that you made the certificate. Yeah.
You can still claim that previous year, yeah.
Correct.
Yep.
Yeah.
The cost is incurred in 2022, but you claim it in 2023 when you release.
Yeah.
As part of the tax return. Yep.
Absolutely, yeah.
Yeah.
So it's important to really, and we'll cover this in a little more detail shortly, but it's important to note the claim is done on your tax return. So the tax year becomes critically important, and then the lodgement of that tax return is what generates the refund process.
So
I know we're going to talk about this later, but this is probably the bit that I had the most problem with, because games as a service is so common these
Yes.
days, and you're constantly updating games for 5 years, 8 years, whatever.
Yep.
That this having a hard date on things to me is a little bit jarring. I know you mentioned multiple certificates.
Look, I share your sentiment there, and I think what it might do is you might see a little bit of what we're perhaps seeing in the film industry, where there's more of a grant funding process that comes to the fore, just to enable the cash flow piece. because a lot of these offset will be about driving cash flow. So how we can finance that will become important. Yeah. I'm sorry, I might just park your question because we're going to run out of time. We've still got a few more slides to go. So let's just quickly talk about the tax implications. We touched on earlier that anything that's expenditure linked to R&D is obviously not going to qualify for the digital games tax offset. Unlike the R&D offset, it works mechanically different. So you are still eligible for a tax deduction. So the timing on that's going to be important, and we'll talk to some examples around that. GST is obviously excluded for the purposes of the offset, which is fairly standard. One thing I'd note is that the way that offsets mechanically work, they're triggered as a refund within the company. And what that will do is mean that any profits that essentially are generated will be retained in the company structure. Now, that has ramifications for release of profits out to shareholders as dividends and the ability for those dividends to be franked. So it'll be an interesting sort of interaction there, and we'll see how this plays out as profits are generated and the offset's claimed. It may result in an unwinding of the net tax impact if a lot of that profit is passed out to shareholders.
So we'll talk a little bit about the application process, and as you can appreciate, it's actually not formal yet, and the Arts Minister has not released any indication as to what that's going to look like. It will be a process, though, where you apply to the Arts Minister, so there'll be an application form, presumably with some records that you need to submit, and essentially some budget-type financial information that explains that qualifying expenditure. The application will be assessed by the Arts Minister, and they'll assess A, your eligibility as a company, so whether you qualify, B, the eligibility of the title and whether the title qualifies as a completed game, a porting game or ongoing. You will presumably need to split out which certificate you're going for in the application, but they'll assess your criteria for that. And then obviously the amount of the qualifying expenditure. So once the Arts Minister has assessed, or his Cabinet has assessed your application, what they will do is they will provide you with the certificate. The certificate will tell you exactly the amount of the offset that you can claim. So it will give you the dollar value that you can claim based on your application. And then what they'll do is they'll send that information to the tax office. So the tax office will know what to expect in the company tax return, exactly the dollar amount to expect, and the fact that you've been approved by the Arts Minister for the offset.
So it's really important to note that sort of two-step interaction: apply for certification and then lodge the company tax return to gain access to the fund.
The cash. Yeah. And we don't actually know with this process, probably one of the important things we don't know is when that needs to be done. If it needs to be done probably following a financial year, but if there is a cut-off point after the end of the financial year, and presumably it will be sometime before the tax return due date, so probably earlier on in the the financial year will end 30 June. It will probably be earlier on in the year, maybe September, October, that it might be due.
Don't know yet.
We don't know, yeah. So just as an example, just to see sort of how the offset actually mechanically works. So assume that a company incurs $750,000 worth of qualifying Australian development expenditure during the period of 1 July 2022 to 30 June 2023. So that's the current financial year that we're in. So what you would need to do to claim that expenditure is you'd need to submit an application to the Arts Minister in their approved form, whatever that may be, and assume that they provide you with a certificate. So assuming all that expenditure met the definition and the Arts Minister applies that certificate, you'd be entitled to a 30% offset on that $750,000. That would equate to $225,000 offset. So assume the release came out, so in that current financial year, so you might have had $2 million of income. You'll receive a tax deduction for the qualifying expenditure of $750,000. You might have other overhead expenditure or admin expenditure, rent, etc. of $250,000. So your taxable income in the company might be $1 million. Under this scenario, if you're a base rate entity, so most businesses here in Australia, you'd be liable to pay tax at 25%, which would be the $250K. Assuming that offset was in place, you would reduce that $250K by the offset, and you would have tax payable of $25,000. So in this case, you're not actually receiving a cash injection, but you are reducing a liability. So you can see it's a significant impact on the cash flow of the business, even though it may not be cash being generated in the form of a refund.
Just a note for the example here, we've deliberately avoided references to the type of certificate or the period there, so just bear that in mind.
Yeah. And a secondary example, which is where it might cross a financial year, or potentially we might be looking at a different type of certificate where your income is less, so you might only have 500k of income in the year of the claim. Again, assuming the same qualifying expenditure and some other expenses. In this situation, the company is actually in what we call a taxable loss. So their expenses outweigh their income in a particular year. In this case, there is no tax payable under the corporate tax rate, but you still qualify for the tax offset of that $225,000, which in this case would then generate a cash refund of $225,000. So as Luke mentioned before, it's all really about the timing of the certificates, the timing of the cash that may or may not be coming back, and really judging that and making it work for you as best you can.
Next one.
So we just, again, we don't know the process, but look, it's going to be pretty relevant that we're going to have some sort of record keeping and some sort of substantiation in these applications to the Arts Minister. The draft legislation does give the effective date of 1 July 2022, which is the current financial year. So assuming it does go ahead for this financial year, it's important to get some mechanisms and processes in place now to track those expenses and what might be qualifying and what might not. I can appreciate that's really difficult when we haven't got the final legislation, so we actually don't know the final things that are included or excluded. But we can do some things now, like setting up specific accounts in your chart of accounts that track these sort of things, or using the tracking categories or projects within Xero. Some studios would already be doing that now, but it might just be something that you might want to adopt now, or start looking at and start thinking about if you really think you might have access to this type of offset.
Yeah, and I think that's the important sort of mechanism to understand is how we're going to bridge the gap between record keeping around, say, time and the records or the financial records of the company. So making sure there's some sort of crossover there will be really important. In an ideal world, using tracking categories within software will help with that, particularly if you're running multiple projects or multiple titles. And I'd say, from a management accounting perspective, that's probably a best practice approach anyway. All right.
I think that brings us, to the conclusion of the technical part of today, and hopefully we haven't put you all to sleep or put you into a nervous situation here. We will take a few questions because we do have a few minutes left at the end here. Oh, yep, we can leave that up for a tick. Yep, there you go.
If the offset results in a refund, is that considered assessable income for the following tax year?
That's a really good question, and no, it's not. So that's a really good result as well. Yep.
Yeah, back.
So would there be a timing difference in cash flows from your tax payment when you actually get the offset back? Or is it like just one payment?
It's one tax return. So so the tax payable and the offset would occur at the same time in the tax return. No, correct. Yeah.
A question down the front here.
So what happens, Mark, is for soft launching and things like that, early access and stuff, if you were to make it public, but then you don't have the 2 years of development, how does that work?
Yeah.
Yeah, look, there was a lot of talk about that in the explanatory memorandum, and there wasn't a clear answer, to be frank with you. There wasn't a clear answer on that. There also wasn't really a clear result, because obviously sometimes games don't go ahead to that completion state. Sometimes it's not commercially viable or something happens and you don't release. So actually, as part of the IGEA paper, it's worth noting that was one of their recommendations, and it is really important for them to consider because sometimes it doesn't go ahead. So there wasn't a lot of clear
We'll wait and see, I think, on that, but
Yeah.
that's certainly an area to be mindful of, and it may be that you end up switching from a first certificate into the second or third certificate then.
Yeah. I think up the back we had earlier.
Yeah. Yeah, so each port is separate and distinct, is my understanding. Yeah.
So if I'm an Indian company, I'm looking for investment internationally. Is this interesting to an international investor, or is it only if they want to start actually trading in Australia under ABN themselves?
Look, I think it's going to be interesting. Yeah, definitely. It's going to defray.
To a publisher, for example, how does this affect how we might structure a deal?
Yeah. It's certainly going to reduce. It's the cost that sort of it'll be a net costing analysis. The challenge here, as always, is a cash flow piece around when you're incurring that expenditure versus. Exactly, yeah. And the unfortunate thing is the timing is a little awkward because ideally by the time you're actually claiming on this expenditure, you've got a commercial release and you're probably seeing profits come through. So it's probably going to play into the way in which funding is handled, and it may well see some of the publishing arrangements change from what is essentially more of a revenue upfront model to more of like a funding arrangement, I suspect. But we'll wait and see, yeah.
Just to be clear how it works for hire agreement is going to interact with the offset. You know, when you're working on someone else's IP and
Yeah.
ultimately someone else's release, to what extent is that?
So only one person can claim it under a work for hire arrangement. So we use the term contracting for that. So in that instance, either it's the IP owner or the developer. It's really the claim is focused around the developer. So you should be seeing the person who's actually doing the work claiming it.
Yeah.
But the risk is if you're using subcontracting, so it's running down the chain,
Sure.
that's where you may be invalidated.
So if there's 3 companies kind of working.
3 tiers, yeah. Yeah, correct. You're going to have an issue. Yeah. All right, I think we've got the wrap up there. I'm sorry. Yeah. So we'll be around at the end if you've got any other questions, or we're happy to take calls out front. Amy and I are also available over the next couple of hours. So if you want to use Meet to Match to book a time to have a chat with us about it, we can speculate together.
Thank you all for your time.